So this new greenfield CFD projects represent a great opportunity for us to rotate our portfolio into newer, younger assets with access to these very attractive long-term contracted revenue streams, extending our own duration of contracted revenues and providing greater visibility and certainty of revenues into the future to support our income offering.
Hello, you're watching Proactive. I'm joined by Toby Virno, Fund Manager for the Foresight Solar Fund. Toby, good to speak with you. The UK government released statutory notices for the latest allocation round of contracts for differences. What does that mean in practice?
Stephen, thank you very much for having me once again. So yes, these statutory notices, they essentially set out the structure and timeline for the clean power auctions for contracts for difference here in the UK. Now, this includes setting out the key auction dates, the budget allocations, and the rules that developers and project owners and developers must follow to secure these government-backed support contracts for renewable generation projects such as solar and wind.
So Toby, taking a step back, can you explain what a contract for difference is and why the UK uses them?
Certainly. So a contract for difference, or CFD as it's commonly known, is a long-term, now it's a 20-year agreement between a renewable generator and the UK government. The contract guarantees a fixed price, which is known as the strike price, for every unit of electricity that's generated by the projects. Now, if the market power price falls below that strike price, the generator will receive a top-up. And if the market rises above that price, then the generator pays back the difference. And that's received by taxpayers and bill payers in the country. The scheme is administered by the Low Carbon Contracts Company and is ultimately backed by bills paid by UK consumers and the taxman as well. The system is designed to provide revenue security for renewable energy projects whilst protecting consumers from price volatility. They benefit when prices are high and they subsidise projects when prices are low. The UK introduced the CFD scheme in 2014 as part of a broader reform of the electricity market. And by guaranteeing a predictable revenue stream for renewable generators and their investors, the government has aimed to lower financing costs, encourage investment, and ultimately deliver new renewable capacity at a lower cost to consumers. The CFDs have been a massive success story and have been a great driver of renewable energy capacity growth in the last few years.
Toby, what opportunities are Foresight Solar seeing following the government's latest allocation rounds?
So for Foresight Solar, we see the most recent allocation rounds as a really significant opportunity. Just taking a step back, our own portfolio of operational assets are, up and running and in operations, and they're backed by prior support schemes. Now, as these assets mature and move closer to the end of these support periods, that represents a fall in contracted revenue outlook and a fall in the duration of contracted revenues for our portfolio. So this new greenfield CFD projects represent a great opportunity for us to rotate our portfolio into newer, younger assets with access to these very attractive long-term contracted revenue streams, extending our own duration of contracted revenues and providing greater visibility and certainty of revenues into the future to support our income offering. Along with that, by bringing projects through construction, that offers opportunities to deliver and realise yield compression as we de-risk projects by taking them through construction and into operations. Combined, the growing pool of CFD-backed projects could provide a source of future investment opportunities to support both income and growth opportunities for Foresight Solar.
So how does this affect Foresight Solar's long-term strategy?
So in terms of the long term, CFD-backed assets offer several attractive features for Foresight Solar. We've talked about the long-term contracted revenues already and how that supports greater visibility of revenues and security of revenues to underpin our dividend. The inflation linkage, with CFD strike price being subject to annual CPI indexation every year, is again an attractive feature and would maintain the inflation-linked nature of the portfolio current revenues. Reduced exposure to wholesale power price volatility is another advantage. We do currently maintain some exposure to the markets, but this offers an alternative opportunity to manage that exposure. The CFD is also very attractive to lenders, and so it would provide improved access to project finance, and that would help facilitate the build-out of some of these projects, which are increasingly large in scale. And greater visibility over future cash flows ultimately would improve both confidence in the dividend for years to come, and also provide security over cash flows that would be seen as valuable when assessing the overall capital value of the projects. Over time, we do want to gradually refresh the portfolio by recycling capital into these newer projects supported by the CFD scheme, exiting well, and then reinvesting to build the portfolio for the future. And it's not simply about growing the portfolio, but enhancing the quality and visibility of future revenues as well. By increasing our exposure to contracted inflation-linked cash flows, we can better support our investment objective, delivering sustainable dividend alongside modest long-term growth.
Toby, I hope you'll continue to keep us updated with progress on your portfolio. Thank you very much for speaking with us today.
Brilliant. Thank you very much, Stephen.
Toby Virno, Fund Manager for the Foresight Solar Fund.